Well, hi, this is Lance Edwards.
And this is Randy Lipke.
And welcome to this edition of Financial Independence, A Better Perspective. And today's topic, another one of these topics that people maybe have heard about, but they're not that familiar with the power of it. And it's depreciation, or maybe lovingly called depreciation on steroids, with regards to your real estate ownership. And I think Randy's going to kick off some questions here to get to kind of seed the conversation.
Yeah, I love this topic. I mean, I love real estate for a lot of different reasons, but depreciation is one of them. So, you know what, just to start out with, Lance, why don't you give the listeners just an overview of what depreciation looks like in a residential property, what the time frame, and just kind of give us an overview. That would be a good place to start.
Yeah, this is what I teach people a lot of, and I find that, Randy, that a lot of people really don't understand it. They don't even. It's a key part of the return you get by owning real estate. It's another one of the arguments I make about why you should own real estate is depreciation.
It's guaranteed part of the return.
It's a guarantee. Yeah, thank you. It's guaranteed by the IRS.
Yeah.
And this is actually a case where Uncle Sam is good to have Uncle Sam as your partner on this one, because Uncle Sam's going to guarantee you a return on ownership of your real estate, and it's through the form of depreciation credit, which you can take against your taxes. Now, the way it works is, let's say, I'm going to use some simple math. I'm going to stick with an apartment example. I'm the apartment guy, but let's say we buy a $1.1 million apartment building, of which $100,000 is the value of the land and $1 million is the value of the building or the improvement. So what depreciation is the IRS allows us, it assumes that that property is decreasing in value in a linear fashion over the next 27 and a half years. Over 27 and a half years, if you own it for 27 and a half years, the value of that building would actually be zero. Now, in fact, the value will have gone up. The value will not be zero. The value will be gone up. But this is a paper loss that we can take. So you take the $1 million divided by 27 and a half years. I'm going to do it right here, Randy. Got $1 million. That's $36,000 per year and change of loss that your building is going down. Well, you get to take the $36,000 and put it as a deduction on your income tax return against your income. So it's offsetting. So if you had $100,000 of income elsewhere, the $36,000 gets deducted, so you're only getting taxed on the difference between $136,000 and $64,000. So let's say you're a 30% tax rate. So 30% of $36,000 is $10,900, which means you just got your cash flow just increased $10,900 because you're paying that much less in taxes.
Yeah, let me pause you there and ask a question, because I know you're going to talk about real estate professional in a moment, or someplace in the interview, but
yep.
I want to talk about how this works with basically anybody at any income, whether they're a real estate professional or not. So typically what people think of in their ability to deduct losses on real estate is if you make less than $100,000, you're allowed to take $25,000 of passive losses against any kind of income. And then as you make over $100,000, for every dollar you go over, you're going to reduce that by $2. So by the time you get to $150,000, all those passive loss deductions are gone, right? You can't do it. Unless, of course, you're a real estate professional, which we'll talk about. But this, what you're just talking about, the depreciation can work at any income level, right? It doesn't matter if I'm making $500,000 a year or $200,000 a year. I can write off $1 of rental income, positive cash flow, against $1 of depreciation at any income level, right?
Precisely. And the thing I want everybody to realize, it's a paper loss. It's not a real
paper
loss of property.
Right.
And let's say, the point, again, if you have let's say on your job income, you have a $100,000 job income. You know, in my example, I just showed you by doing this one transaction, you're going to be able to deduct $36,000 against the $100,000. So basically, if you $36,000 on one property, if you buy 3 of those, now you got a $108,000 deduction against your $100,000. Now you're paying no tax on your job income. You own enough property, you can wipe out the tax you're paying on your job income. And that's what I want everyone to realize. Matter of fact, you do calculations, you can figure out, okay, then how much real estate do I need to own? It's that number of dollars. And let me add another thing that kind of makes it even more sexy and exciting, at least for me, is that it doesn't have to be your money buying the real estate. You could do 100% financing and buying this real estate with other people's money, and you still get the full depreciating tax credit on it. So
talk to the audience a bit about what we mean by paper write-off. Explain to them the difference between that and an actual write-off for something, paper write-off.
Well, I'm saying there's no loss. It's not like, I don't know, what would be a real loss you could deduct? I had something stolen from you, I think, but there's no real loss I've had here. My property is going up in value. And by the way, I don't get taxed on the increase in value, appreciation at all. And so, but I am taking a credit for this theoretical depreciation, which is not even happening. It's just a paper loss that's, again, one of the many tax benefits afforded us as real estate owners.
Guys, let me take a whack at that too. So if I'm managing my rental property, and let's say I have to go buy a toilet for $300, right? So I have to write a check for the $300. I had to literally write a check, and I get the toilet. I'll write off the $300, but I had to spend $300 to get that expense. With this paper loss, with the depreciation, I could get $300 of depreciation, but I don't have to write the check.
Precisely. No, it's just there.
This is there. Like, here's your money, and it's written into the tax code. So, like we said a few moments ago, it's guaranteed. So, all the returns on real estate. You got it depends on, of course, having a tenant paying the rent. But even if the tenant doesn't pay the rent, you're still going to get the depreciation because it's built into the IRS code. It's guaranteed.
Precisely. It doesn't matter if the property is making money or losing money. It's a depreciation against the asset, against the value of the asset. So, and I tell you what a lot of people don't do, and I'm just sharing everyone listening. You should be taking this into account when you're evaluating the properties you're going to buy. This is part of the ROI.
It is
on that of what you're putting into the property. There's a depreciation is part of the return on investment. And I can tell you right now, when I run the math, typically that number is around no less than 2.5% up to 4% return you're getting on your cash in the property. This paper return, and it's real money. It's cash flow. It's more cash flow to you because it's less cash you're paying in taxes to the IRS.
Yeah, and you kind of hit this point in the beginning, but just to make it a little more clear to people too. Again, when you buy a property, you're buying two things. You're buying a building that sits on top of the dirt, right? So the dirt is one and the building's the other. The dirt we don't get to depreciate, the building we do. So one of your evaluations when you're looking at a property is that relationship between the value of the dirt and the value of the building. And I live in and work out in Newport Beach, California. To give you an example, this is one of my favorite ones. I just saw this about a year ago. There was this little cute little beach house for sale in Laguna Beach, which is one of our nice ocean communities here. And in the picture, in the listing picture, they had like a picnic table with a chair and a Corona sitting on the table, and then this beautiful ocean view, right? And the sales price for the property was $14 million, and the building on it was built in like 1929, and it was like 400 square feet, right? So the depreciation, the ratio of land value to the doesn't work there.
Yeah.
But if you get away from the coast and you go to normal, anywhere in these higher price, coastal communities of big cities, typically you're going to see about 50, 60, 70, even 80, 90% of the purchase price, the land. What you want is just the opposite, right? You want the purchase price to be 10 or 20% land and 80, 90% building, because then you get to depreciate it. That was my point.
Yes, and it's very good, which will more likely mean that's a cash flowing property to begin with anyway.
Absolutely.
That's just going to be it's going to work itself out.
Yeah.
Now, Now, the one thing about this, Randy, because we're talking about this, there's this 27.5-year depreciation schedule, straight line residential, and it's 30 years for commercial property.
39.
39, excuse me, 39.
Yeah.
And so residential includes apartments as part of the residential definition. However, talk about depreciation on steroids, you can speed up the depreciation because the 27.5 years strictly really applies to the building, the improvement on the land.
Right.
But inside that improvement are the appliances, the air conditioning, which they depreciate on a much faster basis than the improvement. And depending upon the component, and this gets into an area called componentizing, you can separate the value of the appliances, the value of the air conditioning equipment, and depreciate that on an even shorter schedule, 3, 5, 7 years, which accelerates, you get a higher return earlier from your depreciation. It's called componentizing or cost segregation, which basically means in my example, I had $1 million improvement. Well, some portion of it goes to appliances and AC, and some part goes to the building, and you can accelerate that quickly. Now, again, componentizing, and it's very powerful. Makes a lot of sense. If you're going to do that, you've got to hire, bring in the professionals, and they will do those studies for you.
Right.
I will share with you, there's a cost in doing that, but there's at some point of value, you got to make a trade-off between the cost of the study versus the accelerated return you're going to get in your appreciation. And generally, on your small properties, probably small to mid-sized properties, the justification is not going to be there. But there's going to be a point to where you definitely want to do the componentizing, and you can accelerate that ROI you're getting from depreciation.
Yeah, that's a really good point, because I see a lot of these real estate groups, and they're really hyping up the idea of doing this cost segregation studies, because obviously it's more beneficial to get a write-off on depreciation today than it is 10 years or 27.5 years from today. But what they don't talk about is the cost, and that's what you're saying. Look, if it's going to cost you $5,000 to get in appraisals to get $4,000 of benefit, why do that?
Yeah. So, but the 27.5 years is yours.
Guaranteed.
By birthright, being born in this country, and as long as the tax code stays the same, you've got that 27.5 years.
Yeah.
All right. Now, I'm going to come back to, we've entered this range. Let's talk about real estate professionals, because there's, on this, because there can be caps on how much depreciation credit you can take in a year. I don't know what the number is now, but it's small. I mean, it's small.
25,000.
25,000. That's even better than it used to be. Okay, 25,000. So, but let's say in my example, I had, what did I give? $36,000. I had a $36,000 example. Well, to bypass the $25,000 cap, you simply need to declare yourself a real estate professional. Now, what does that mean? Well, first of all, it does not mean you have a real estate license. It has nothing to do with licensing. That's a lot of confusion over that. It means, do you devote at least 750 hours per year to real estate? Well, that's basically 15 hours a week. So if you're doing this just part-time, yeah, I'm a real estate professional. I can say, yes, I devote 750 hours per year. And so to declare yourself, when you or your CPA submits your tax return, the important part is you got to check the box, make sure they check the box. I'm a real estate professional. That takes the shackles, that takes the limits off of how much you can depreciate. And by the way, your CPA may not even know that. So be sure, don't assume they're going to do this for you. Ask them, and pointedly, did you declare me a real estate professional?
Can I make a couple comments on that? Yeah.
Please,
please. First of all, in terms of qualifying as a real estate professional, I know we're going to give our websites at the end of the podcast here, but I have some really great checklists that you can use to see to see if you do qualify, and then it will give you the IRS codes that are associated with it and things you need to make changes to allow you to qualify. But just a couple specifics details on that. You mentioned the 750 hours. That's the minimum amount of hours that has to be involved with what's called active management of real estate. This is an important part of it because a lot of us own real estate where we're hiring property managers, right? So that, like I have
Yep.
clients in Hawaii and they're buying properties in Oklahoma, right? And so they're not going to fix those toilets. They've got property managers. So you have to be careful. You can still qualify as a real estate professional if you're working with property managers, but you have to be actively managing those properties. And so what would be some examples of that? Some examples of that would be if you allow your property manager to go ahead and advertise for tenants and let them do the initial screening, but then you review those screenings and help make the final selection for the tenant. Now you're actively involved in that tenant selection. You're not doing all of it, but you're doing some of it, and that time would qualify as active management. There's a number of different areas, but the active management thing is a real important gotcha, because a lot of people think, hey, if I just own some properties and have property managers manage them, well, I get my 15 hours a week in and I'm good to go, I can be a real estate professional. No, active versus passive management. Second thing is, it has to be a real estate professional, it has to be your primary occupation. And this is another one that gets people, because the 750 hours is a minimum, right? But if you're working a full-time day job, 40 hours a week, I can't do this in my head, Lance, but 40 hours a week times 52 weeks, how many hours is that? 2,000 or something, right?
2080. Yeah.
Yeah. So if it's 2,080 as in my day job, I would need to work 2,081 hours as a real estate professional. So basically that would be, 40 hours a week as a real estate professional, and in 1 week you'd work 41 hours. Right? And it's not going to happen, right? I mean, it's just, unless you're not going to sleep at all, you're just not going to get that many hours in. So if you're a part-time worker, or this works very good for spouses, right? Because sometimes we have a spouse that's working full-time, the other one that's working full-time at home. Well, that full-time at home spouse, all they got to do is get their 750 hours in, and because you're filing a joint return, the real estate professional benefits would pass to both parties. So the caveats there is, it has to be your primary occupation, 1 hour more than anything else, and at least 750 hours. And as you said, Lance, you don't need a license. Right, that's not a prerequisite. But in the event of an audit, you do need to be able to document the hours, and that can be done by just keeping a simple journal of the time that you were involved with actively managing your rental properties.
That's perfect. Excellent. So at the end here, you're going to get a website. We can go to Randy and get those checklists.
Yep.
And now let's talk about some of the build upon this. Okay, so you bought this building. You got your depreciation. You've owned it for a few years. You've been taking these credits, depreciation allowances every year. Now maybe it's 5 years down the road. When you sell the property, there's something called depreciation capture. Uncle Sam's going to be there. Now they want their money at that point.
Yep.
So you've depreciated $36,000 a year times 5 years, $180,000, and they're going to want that back. So in this case, that's $180,000. What's the math on that? It's 25% tax rate
5%.
On that, right?
That's right.
So $180,000 times 25% is $45,000. You'd have a tax hit on. Well, that's not so cool. That's just let the air out of your balloon. So to avoid, Womp, womp, womp.
Yeah, it still could be lower than your marginal tax rate at your earnings rate.
Yeah.
So it's a preferred rate.
Yes, but up to now it was, I'm getting all this credit. I'm getting, wait a minute, I got to pay at the end of the party. So to avoid to avoid that. Well, first of all, you could not sell. That's one thing. But to avoid it, when you do sell, if you do a 1031 exchange into another property, it resets on the purchase of a new property. It resets your depreciation basis. In other words, you're not paying any tax. And now
kicking the can down the road.
Thank you. Kicking the can down the road. Exactly. And now Randy and I have done another podcast preceding this one solely on 1031 exchanges, which you're going to go hear about that. It's very simple, and you definitely want to make it part of your arsenal of how you avoid paying capital gain tax of any kind or any tax as you sell and buy these properties, because it's a way to quickly ramp up your net worth. Now, so go listen to that podcast on 1031 exchanges, because that resets the whole depreciation thing. So now you're still good. However, I'm going to just whet your appetite. When you listen, I want you to listen to the other podcast. We're not going to repeat it all here. But if there's any downside to the 1031 exchange in resetting your depreciation basis, it's that you got this time limit. I got from the time I sell property A, I got 45 days to select some candidates of what I'm going to buy. Then I got 180 days from the sale of property A to close. So you got this tight time frame. And well, maybe I sold at the peak in the market, and I don't necessarily want to buy it at the peak in the market. I want to sell at the peak and buy when prices are back down. So to do that and also reset the depreciation basis, also pay no taxes, Randy explains something called a deferred sales trust in the other podcast. Now, Randy, why don't you give the Cliff Notes version, or at least whet their appetite on the deferred sales trust and why they need to go listen to that podcast on 1031 exchanges.
Yeah. So the benefit of the deferred sales trust is multi-fold. The first one you just mentioned is it eliminates this time constraint that we have on the 1031 of having to find an up leg in 45 days and then close in 180 days. Most people don't have a problem in closing in the 180 days, but sometimes it can be difficult finding a property to exchange into in that 45-day time frame. And again, sometimes it's not ideal to even sell in a high market and buy in a high market. So the deferred sales trust mitigates those problems. The other thing that we love about the deferred sales trust is it's not restricted to real estate. I can sell any highly appreciated asset and defer the taxes on it. I could sell my business. I could sell cryptocurrency. I could sell my artwork that's appreciated in value, not pay the capital gains on it, and I'm not restricted on to what I purchase with the proceeds. I can do the same thing. I can buy businesses. I can buy cryptocurrency. I can do what I want to. So the deferred sales trust is just a 1031 exchange with a lot more whistles and bells, choices and options, and it's really worth listening to that podcast.
You got to listen. You got to listen. And then you get just to not to confuse, but there's another option in there called a Delaware sales trust, which is even another option of how to do all this.
Delaware statutory taxes. Delaware
statutory trust. Excuse me, Delaware statutory trust. They're both DST. That's where DSTs. Yeah. So to kind of summarize here, guys, listen. First of all, you need to own real estate. There's no bigger advocate than me. And the benefits of it, you got an appreciation benefit. The value is going to go up on your real estate, and you also, the point of this podcast, you got a depreciating benefit. We get to take that credit. So, and if you want to pay zero tax, then you're going to take that depreciation credit. To pay zero tax, you're going to have to use either a 1031 exchange, or a delayed sales trust, or a Delaware statutory trust. So we give you the highlights of depreciation here. Go listen to the other podcasts on how you're going to capture and keep all that money in your pocket. Randy, what else would we need to cover on this, do you think?
Yeah, I think there's a couple more points I'd like to bring up too. So the basics is, the fundamental is this: we want to take write-offs as fast as we can, ideally today. And so by accelerating the depreciation, listen to the weed whacker. This is like the COVID thing, right? All the doing it from our home offices. So we got the gardeners outside right now. Anyway, we want to take our expenses as soon as we can and not put them out 27 and a half years. If we can get it done tomorrow, we want to take the write-off tomorrow. So we want to pay, get the deductions for our expenses as fast as we can, and we want to pay the taxes on gains as slow as we can out into the future. So to drop down on that again another level, when we write a check to do things for our rental properties, there's also a decision between whether we call it a repair or whether we call it an improvement. Do you want to talk about that a little bit, Lance, or you want me to get into that?
Go ahead. This is there's a lot of confusion around this. I read P&Ls all day long. Even with professionals, there's confusion. So please go ahead and proceed with that.
Okay, so the idea is that if I'm repairing something, again, if the toilet breaks and I fix it, I'm going to get to pay for the repair and write off 100% of that repair immediately. And Lance, I don't know. Can you hear me at all?
Yeah, I hear you're coming in loud. So I do now that I recognize there's a weed whacker, but you're still broadcasting. You're still good. You're still good.
All right. Well, I'll keep talking. I got a microphone that does background noise reduction, so I guess it's working pretty well. So again, the toilet, if it breaks, I can bring in the maintenance guy and have him fix it and repair it, and I'll write off 100% of that expense right away. That's the goal. We want to write off stuff right away. Now, the toilet itself, if it breaks, I may not be able to write off 100% of it. It might have to be depreciated over a few years at time. I'm just using that as an example, and we really don't want that. So let's use another example, like a roof, right? So if I had to repair a roof, fix leaks or tiles or replace shingles or whatever, I'm going to write off 100% of that right away. But if I replace the entire roof, now I have to depreciate that out over time. So the idea here is, again, when you're when you're investing money in your property, ideally you want to find a way to call what you're doing an expense. So you can write it off immediately 100%. And if you can't, then you want to see if you're going to have to defer it over time, if you can use one of these accelerated schedules to get it done faster than would otherwise be normally applied. So again, repair, write it off immediately. Improvement, write it off over time. We want repairs, lots of repairs. Well, if we're going to spend money.
Yeah, and if you have you don't need to hire a consultant to do depreciation on some asset you bought while you're owning the property. But you just do it. Your CPA will help you with that. CPA will help you with that.
Yep.
All right. This is excellent. So depreciation, and then when you get ready to exit, you got these different options to you: 1031 exchange, delayed sales trust, or Delaware statutory trust. Go find the podcast titled 1031 exchange. Don't worry about those as well.
Good.
Randy, how do they plug into you? How do they get this checklist on the real estate professional?
Yeah, so the way you do that is you're going to go to my website, which is lifetimeparadigm.com, and I'll spell that out for you. So Lifetime, LAFETIME, and then Paradigm's a toughie, PARADIG as in George, M as in Mary, lifetimeparadigm.com. And when you get there, there's a little search box, and you can just type in real estate professional. It'll bring up a number of different blog posts, and one of those will be the post on the real estate professional. There's a lot of articles, recordings, podcasts, videos on real estate investments. And again, we're independent fiduciary advisors, so we're not just restricted to real estate, we just like it. But if it's about stocks, bonds, mutual funds, life insurance, annuities, tax planning, asset protection, estate planning, all that stuff's there. And the one thing I would encourage every one of our listeners to do is to enroll in our Financial Independence Toolkit. It's 100% free. There's a ton of value you get from it. Just go ahead and click on the little Einstein. It'll take you to the link that tells you what the toolkit's all about, and enroll in that and take advantage of that offer from us.
I got to think about your website, Lifetime Paradigm. I got to believe that maybe some people maybe mistype or I suggest you go maybe buy all the URLs with the misspelled versions of it and have them all funnel to the correct place. So, all right. So listen, if you want to enter my world and look at investigating into apartments, get my book, best-selling book, How to Make Big Money in Small Apartments. You can get it for free. Go to freeapartmentsbook.com, freeapartmentsbook.com. It actually just pays $6 shipping and handling. We'll send you the book and some other educational materials on apartments, so you can start applying depreciation, appreciation, 1031 exchanges, etc. And for the archives of all these sessions and to find the podcast I'm referring you to on 1031 exchanges, you can go to fibetter.com, fibetter.com. It's our archive, and it has all these links we're giving to you right now. So if you didn't write it all down, it'll be on there, fibetter.com, and a lot of cool stuff. And the last thing I have a request from both Randy and I is, if you're listening to this on iTunes or whatever channel you're listening to, hey, do us a favor. If you're getting value out of this, give us a 5-star rating. It helps propagate it throughout the world, let more people know how to get contact with the information. So
that's great.
So with that, Randy, fabulous as always. I love doing these with you.
You as well, Lance. I really enjoy it. Really do.
I really think it's really cool. And until the next time, everyone, go work on that financial independence and take care.
Bye, Lance.